This issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away.
The industry understands that we are a target.
There's evidence that the actor's ransomware is in Russia.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Tuesday, the 11th of May. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Inflation fears get the better of markets. Stocks sell off across the globe as tech bears the brunt of the declines. Now, U.S. futures point to further losses. Gas stations on the East Coast run dry. The biggest pipeline in North America races to recover from the cyber attack that has kept it shut for 3 days. And Intesa Sanpaolo announces a share buyback scheme as the chief executive signals that more M&A is in store for Italy's banks. Carlo Messina joins the program very shortly. Now let's get straight to the markets. It's a sea of red for equities as fears over inflation seem to take hold. Tech has been the biggest loser so far, with the Nasdaq taking a beating in yesterday's session. Meanwhile, the Hang Seng has now fallen 30% from the February peak. Well, let's get straight to our Danny Berger, who has a deeper dive into the sell-off. Danny, is this all linked to inflation?
Well, look, it certainly seems to be, just judging by the price action we've seen from the equity market. Now, the bond market might be a different story here, but it really is remarkable that we have these fears coming so quickly back into the market after the NFP report on Friday, where it seemed to be saying, okay, this miss means that fear can ebb, but not so. It is back in full force yesterday, with Europe catching up today, and it really is a wider sell-off we're seeing in Europe, but still in the Nasdaq futures, those are underperforming the broader market. Now, we are seeing a touch higher in U.S. 10-year yields, 1.16, but there does seem this relative sense of calm in the bond market. Perhaps it knows that inflation is here in the future, that interest rates aren't going to rise quite yet, but maybe it's down the line that we're going to get that interest rate rise. But the growth equity market needs to catch up to that story. And to give you a better idea, let me take you into my terminal show. I can show you exactly what the factors look like, because I think this was really telling. Here's yesterday's U.S. session. So at the very top here, we have size, which is small caps, and value. So these are long, short versions of these factors. And this is really rotationary vibes, the fact that we have value and size outperforming. And on the bottom here, we have momentum and we have growth. Now, Michael Bachnick points out that of the 52 stocks that doubled in price in 2020, 38 of those have lost money so far this year. It's almost as people are exiting these stocks as quickly as they entered them last year. Here's today's European session in the factor portfolio view as well, and it's value, dividend yield on the top, earnings and growth also on the bottom. Same rotationary sort of vibes we are getting from the market. And why is this going on? We really have this big dislocation in market. This is from the ISM manufacturing report, and this is the divide between supply and demand. In other words, in order backlogs and inventory as well. So it's really this sort of picture that the market is grappling with, and then you add in possible wage inflation, Francine.
Thank you so much, our Danny Berger there with some of the market moves. Now, Italy's banks are coming out of the pandemic on the front foot. Lending in the last 3 months has jumped some 4.2%, which is largely linked to ongoing liquidity needs for Italian businesses. But at the same time, bad loans have declined to only 3.8% of overall lending. Now, the country's biggest bank, Intesa, has staged a rally since reporting results last week, where it joined peers in taking a more optimistic view of the European recovery. Well, this morning it also announced a share buyback program over $200 million. So joining us is Carlo Messina. He's the chief executive at Intesa Sanpaolo. Mr. Messina, thank you so much for joining us today. First of all, when you look at the trend going forward, how optimistic are you that what you've released so far in terms of earnings, profit up some 32%, can be on the footing ahead?
Sorry, Francine, we didn't announce the share buyback. It's been UniCredit, so it's just important just to give investors something that can move in a different way, because we prefer to pay cash dividend and not to have share buyback. Looking at the future, I think that the perspective could be very positive, in particular for a bank like us, leveraging on wealth management and insurance. The pool of saving is so strong in the country, and I'm just looking that a significant number of corporate clients is coming back to investors, and a lot of confidence within the country. So I'm pretty confident that there will be a significant rebound in the next quarters in Italy and in Europe.
Carlo, huge apologies for that. You didn't, but I think that a lot of the markets want to know actually when there's the unfreezing from the European Central Bank for either buybacks or dividends, what exactly you will do. Can you enlighten us on your position right now?
Yes, the real point on dividend is that at the same time you should have a significant net income ability generation, and Intesa Sanpaolo today is one of the strongest banks in Europe also by net income generation. At the same time you have to have an excess capital. Then probably we will have to wait for the EBA stress test results in order to have the final position of ECB. I'm quite confident that ECB will remove the ban for all the European banking sector, especially for Intesa Sanpaolo. I'm pretty confident that we will pay 700 million euros cash dividend in May. Then we will be asking for an authorization to pay another 1.9 billion euro out of the net income that we generated in 2020, and we will ask for the permission to pay an interim dividend in the second part of the year out of the 2021 net income. So during 2021, our expectation is to be in a position to pay significant amount of cash dividend. In the next business plan, we will analyze the future profitability, and I'm absolutely confident that our business model will generate significant net income, and then we will analyze also the significant excess capital and the way in which we can redeploy excess capital to our shareholders.
Carlo, when you look at some of the things that you're now focusing on, it's really integrating UBI. You're focusing on expanding the bank's most lucrative business. What do you see as the main challenge for you and the bank in the next 12 months?
So for sure, it's something not related to the bank, because we completed, and believe me, in a year of a pandemic situation, to make an acquisition that probably has been the most important in Europe in the last years, and starting all the M&A for the European banking sector, making the integration, and not only the integration, but the largest ever disposal of branches that we made to BPER Banca has been not easy, but we completed in a very successful way. So that's a confirmation that we are a delivery machine in realizing target that we gave to the market. At the same time, what I consider really important is to check the GDP dynamic in the world, so the exit from the pandemic. If the exit could be the one that is today on the table, so after the summer to be in a normal position, I don't see any kind of significant threats to our managerial actions. The real point for us will be to announce at the beginning of 2022 a new business plan in which we will put emphasis on wealth management, insurance, digital, ESG, and then to dividends and significant return to our shareholders.
Carlo, in the last interview, I think you were saying that you were targeting some possible small deals in wealth management and private banking in Europe. Have you made any headway in that space?
So my point on the acquisition item is that we can make a choice between making acquisition of a team of private bankers, or making an agreement to place distribution of our asset under management factory, or at the same time making evaluation of target that could be not significant. So at the end, our purpose is to increase the amount of wealth through internal generation. Let me give you just a figure, because in my view, investors and analysts are underestimating what we did during last year. We increased our wealth management amount of savings that we have from families from 1 trillion euros to 1.2 trillion euros. 100 billion is coming from the acquisition of UBI, and the other 100 billion is coming from internal organic growth. So we have still a significant ability to grow internally without any kind of acquisition, and our focuses will be on this, because the pool of commissions that we can derive from the internal growth is so high that there is no possibility to create value through acquisition, and much better to increase our pool of saving working with our clients due to our 30% market share in the country.
Are you worried that actually banks in general in Italy are too optimistic about the way forward? At the moment, a lot of the markets and a lot of investors are behind the Prime Minister Mario Draghi. They're behind the economy. What if there's a second wave, Carlo? What if there is a further lockdown because of COVID-19?
So it is clear that in Italy we have now a unique opportunity to have Mario Draghi being the head of government. The reputation of Mario Draghi within Europe is the key factor of success to have an acceleration in next generation EU funds. And in order to accelerate the GDP growth in the country, we have a lot of inequality in the country, like in all the other European countries, a lot of poverty, a lot of unemployment, but the acceleration of 4% GDP growth in this year and 4% GDP growth in 2022, and then hopefully a growth above 1.5% GDP growth can allow the country to accelerate and to remain one of the best players in Europe. Looking at the COVID-19, the vaccine campaign is the key factor of success, and I think that at the end this will result into a positive trend and a return to normality. What we need is absolutely to accelerate the GDP growth. There's no other point that we have to realize in the next years.
So you don't think you're too optimistic, given the bad provisions on the future impact of the pandemic on banks' credit?
So the real point is that you have to know your clients, and we are in the unique position, having a 30% market share in the country, to know all the cash in and cash out of our clients, both corporates and retail clients. We made an analysis client by clients on all the clients that we have in moratoria and those the clients that received guaranteed loans. And these clients have a lot of liquidity in their accounts, SME corporate. And SME retails, also the owner of the SME retail, maintain a significant amount of liquidity on their personal account. So in Italy, there is only a phase of uncertainty, apart from tourism, some sectors that are really impacted by the lockdown, but we are talking about 2% of the total amount of the moratoria loans. So we are talking about something that is absolutely under control. And this is for Intesa Sanpaolo. I think that this is also the same for all the Italian banking sector. So I'm realistic, not optimistic. So situation is, in my view, under control. If GDP will increase by 4%, we will be out from this difficult situation.
Carlo Messina, how much consolidation are you expecting this year amongst Italian banks? And then will that spur a wave of cross-border consolidation in Europe?
So on consolidation in Italy, I think that there will be consolidation. It is also clear that we made the first move and the best move, because putting together the two best banks in Italy, we realize the first step, having the possibility to create the best player in the country, to reinforce the best player. Now the remaining part of the banking sector will have to combine within players that, in my view, will generate another two group in Italy that will compete with Intesa Sanpaolo. But the position of Intesa Sanpaolo is so strong that it is difficult that we can have a real competition. But my view is that there will be merging between banks, and the result could be two other groups in Italy. Looking at the European situation, is not easy from the M&A point of view, looking at the synergies that you can create making a deal, because at the end, investors that have the majority of the capital, international investors, the majority of capital of all the big players, will want to have earning per share accretion and dividend per share accretion. If you are not able able to create this, they will not give you the okay in the shareholders meeting to proceed with an acquisition. And to create synergies, not having cost synergies, it is not easy. Merging a bank that is in a country with a bank that is in another country, it is not easy to create cost synergies. So I think that we will have in the next years, but not in the short term, some cross-border consolidation, but the key driver of success will be the cost synergies. Otherwise, it would be difficult to create other players through cross-border consolidation in Europe.
Carlo, thank you so much for the interview today. The chief executive there of Intesa Sanpaolo. And just to correct something that we said earlier, Intesa did not announce a share buyback this morning. It plans to distribute cash this year once the ECB's payout freeze, of course, is lifted. Now, Joe Biden stops short of blaming Russia for the ransomware attack on America's largest gasoline pipeline. We discuss the latest on the colonial hack up next. This is Bloomberg.
So far, there is no evidence based on from our intelligence people that Russia is involved, although there is evidence that the actors, ransomware, is in Russia. They have some responsibility to deal with this.
That was President Biden stopping short of blaming Russia for the cyber attack on America's largest gasoline pipeline. Well, he says that the country has some responsibility to address the ransomware attack. Now let's get straight on the latest with the Colonial Pipeline hack. Joining us for more is Bloomberg security reporter Jamie Terabay. Jamie, what do we actually know about Russia's potential involvement?
Well, as we just heard, President Biden has said that the evidence does sort of hint that there is some responsibility there from Russia. This isn't the first time that we've heard Russia kind of be involved in cybersecurity activity. We know that it was only a couple of weeks ago that the U.S. administration filed sanctions against some Russian actors. We have the SolarWinds attack that happened, late last year. And there's so many things about this attack with Colonial that cybersecurity experts have said have all of the parameters of a Russian-based or Eastern European-based attack. Some of the things that these hacker groups do is deliberately tailor their targets. They look for a script that doesn't have like Russian characters or anything like that. So there is very strong evidence suggesting that. However, there's nothing conclusive that we've seen, and we're still waiting to hear. Obviously, the Kremlin has denied any involvement at all in past attacks. We haven't really heard what Moscow has had to say about this one.
There's been some confusion about the attackers now saying they didn't know that the pipeline was going to be targeted.
Right. So the hacker group that the FBI said is responsible for this is called DarkSide. And what they do is they provide ransomware as a service. So essentially, if a hacker group or a cyber attacker is looking to launch an attack on a target, they can then implement the product that DarkSide sells to essentially lock up the networks, which is what's happened here in Colonial. The IT network has essentially been hijacked by the attackers and encrypted. So, and they've demanded a ransom to have those unlocked and de-encrypted. DarkSide has said, and they've come out and they've made a statement on their website that they said that an affiliate might be responsible and that they never really intended to cause so much upheaval. They say that their malware is offered as a service, and they believe one of their customers was behind the attack. But, we've been talking to cybersecurity experts and people who've been tracking and studying groups like DarkSide, and they said that what they essentially do is they provide a weapon. So whether they're the ones who've launched the attack themselves or they're the ones who've allowed it to be deployed, it doesn't really kind of hold up, especially when we're still seeing this attack unfold, especially when we see the ramifications of this attack still being felt across the United States and actually getting worse, particularly with the fuel shortages that we're seeing, the panic buying that we're seeing, and the impact this is really having across the country, not just the East Coast anymore.
Jamie, thank you so much. That was Bloomberg cybersecurity reporter Jamie Tarabay. Now, coming up, the fallout from the tech sell-off yesterday continues. What we're looking at is really a technology-led sell-off that started on Wall Street, now snowballing in Asia and Europe. I'm looking at the European stocks down some 2%. Again, the worries are over inflation, and that's pushing investors to dump expensive stocks. Dollar and Treasury pretty much steady. More on the markets throughout the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. It's all about the markets, and actually the markets today are really falling out of bed. This is on the back of the Federal Reserve, the question over whether it will tighten policy sooner than current guidance suggests. I'm looking at a technology-led sell-off that started on Wall Street, now snowballing in Asia and Europe, with the European stock 600 down 2%. Coming up, more on Amazon. Inflation fears get the better of markets while stocks sell off across the globe as tech bears the brunt of the declines. U.S. futures point to further losses. Gas stations on the East Coast run dry. The biggest pipeline in North America races to recover from the cyber attack that has kept it shut for 3 days. And Amazon raises more than $18 billion it doesn't need in a new debt sale as corporates sit on ever-growing piles of cash. What are they going to spend it on? Well, good morning, everyone. I'm Francine Lacqua here in London. Welcome to Bloomberg Surveillance Early Edition on Tuesday, the 11th of May. Now, Amazon has issued $18.5 billion worth of debt. It's the first time that the tech giant has borrowed from capital markets since June 2020. Offered up in 8 parts, the smallest was $1 billion to be used for sustainable projects. Well, joining us to discuss all of this is Danny Berger. Danny, you've made us smarter about exactly what this huge debt offering could mean. So it doesn't really need the cash.
No, it really doesn't. I mean, look, in its last earnings, it talked about $73 billion in cash and cash equivalents sitting on its balance sheet. And look, here's the 8-part debt offering. And it certainly raises questions why you would do this if you already are so flush with cash. Well, to one degree, Francine, it's a market environment that a lot of corporations just really can't ignore. To one extent, you have 10-year yields that, of course, we're talking about this inflation picture, but they're still hovering around 1.6%. So there's demand for this. And indeed, we saw Amazon raise more money than they had initially planned. And let me also take you into my terminal, because we're also seeing just spreads that remain extremely tight. I mean, this is really near crisis lows. So it means that they can take out debt. They can do it for cheaper. They can refinance debt. And Francine, this is something we're seeing a lot of companies do. They're not paying down the debt, the massive debt piles they already took out because of the pandemic. They're just taking this opportunity to refinance and in a way kind of clean up their balance sheets because this picture allows them to do so.
Danny, what will they even be using the debt for then? Yeah,
that's really that is a really important question here. And I have to say that their filing didn't really give any clues besides that sustainability $1 billion. The rest of it just says, look, we're doing this for general corporate purposes. Now, Moody's here taking a very unusual step of upgrading a company when they're taking on more debt. In their view, they say, OK, this temporarily increases leverage, but long term it's positive if it's going towards growth. But Francine, this is the corporate story of 2021, in my opinion. How do you use it? Is it used towards growth, or are companies just going to go ahead and go in and buy back shares? Now, if it's going to be the former, that obviously means something good for the economy. It could talk about the inflationary picture, but so far, we just have seen buybacks come back into the market. And again, this idea of refinancing the debt, despite the fact corporations have so much cash at this moment, Francine.
Danny, thank you so much. Our Danny Berger there with the very latest on Amazon. Now, joining us is Stephen King, Senior Economic Advisor at HSBC. Stephen, there's a lot to talk about when it comes with inflation, actually the huge market correction. But Amazon going after new debt like this, is it symptomatic of something with the system? As an economist, you look at this and you kind of think, right, what does it mean for, the way the money is moving longer term?
Well, one thing you might say is that with interest rates both so low, but also feared to be rising at some point over the course of the next 2 or 3 years, then perhaps now is the time to take on more debt if you really have to. But I think that your early discussion was important in the sense that what really matters is what you do with the debt. And in recent years, long before, in fact, the pandemic, the obvious thing to do with the debt was to do share buybacks, effectively to return money back to shareholders. And that's partly associated with demographic change over the last 20 or 30 years. Shareholders themselves have got older. What they want from their companies is money returned to them to be put back in their pockets, either in the form of higher dividends or share buybacks. And that allows them to consume today rather than allowing the company to invest for tomorrow. So what you end up with is support for sort of incomes of pensioners indirectly, but at the same time, not much in the way of long-term investment and not much in the way of decent productivity gains.
Do you expect, I mean, on the productivity puzzle, does it get better with technology? I mean, the million-dollar question is whether we're creating an economy that's sustainable or it isn't. A lot has to do with inflation, and we're seeing markets zigzagging that. Like, what kind of recovery do you think we're seeing?
Well, one of the peculiarities in recent times is that we've had lots and lots of technology, but very little in the way of productivity. Now, some people say this is just a measurement problem, that actual productivity is growing faster than measured productivity. But actually, all the other indicators in the economy would suggest this is probably not fully true. Tax revenues are relatively low, wages are relatively low. There isn't much sign of a sort of feel-good factor associated with all these new technologies. And frankly, when you talk about building back better, which is what you hear on either side of the Atlantic, the hope very much is that you can get a productivity surge, but there isn't much sign of it at this stage.
When when you look at what the Federal Reserve really main task is doing, are they navigating it okay? And Stephen, we also spoke to Robert Kaplan, and this is what he had to say about some of the CPI readings.
While you don't want to be preemptive, you also don't want to be so reactive that you're late, in that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance.
So, Stephen, what is the biggest danger? That actually they overheat the economy a little bit, or that they understimulate?
Well, I love the idea of finding the balance, because policymakers would always love to find the balance. And more often than not, they don't get it right because, of course, they're always looking at the economy with a rear-view mirror. Stuff has already happened by the time they get round to perhaps raising interest rates. I think at the moment, one of the big unknowns, frankly, and this is what policymakers should be prepared for as a kind of sort of contingency, is the possibility that as lockdowns end, as the vaccine program really builds significantly, then you might find that all that sort of pent-up demand that built up through people's enforced savings last year begins to spill over onto the high street and elsewhere. Now, under those circumstances, you may find that growth is far stronger than people had originally expected. That puts pressure on resources, puts pressure on commodity prices, possibly puts some upward pressure on inflation itself. So there are two issues here. The first is, does inflation itself rise? And the other issue is, if central banks fear it could be rising, do they move earlier on interest rates than they have so far indicated?
Where do you see, is this, I mean, are we potentially importing actually inflation from China?
Well, Chinese inflation this morning, I mean, producer price inflation was relatively high. There's not much sign of it feeding through to consumer prices. But in terms of importing inflation, it's coming from a series of different areas, really. And I think part of the issue here is the supply disruption associated with COVID, that the supply chains that were so reliable before the pandemic have become a little less reliable. There are more shortages around than they used to be. You're getting pockets of price increases coming through that we're not really used to. Under those circumstances, not so surprising that we're seeing some increase in producer price inflation. Where I think there's a bigger uncertainty is the extent to which that spills over into consumer price inflation. And the usual story here, historically, is that you would need to see not just rising commodity prices, but also rising wages. And frankly, over the last 10, 20 years, whenever we've seen a kind of cry wolf increase in oil prices or other commodity prices, it's never really fed through to overall consumer price inflation for the very simple reason that wages themselves have not really responded.
Stephen, thank you so much. Stephen King there from HSBC stays with us. Now, a story to watch out for on Bloomberg. Today's Big Take takes us inside one of Switzerland's most secretive private banks, Pictet, which has more than $600 billion of assets under management, has been looking after the money for the ultra-rich for over 200 years. But the Swiss lender is finding some tensions now, adapting to the modern world. Possible culture clash between new hires and the old guard has led to a wave of resignations from key employees. You can find the whole story on Bloomberg.com or on NI Big Take Go. This is Bloomberg.
We know that there have been reports of this rogue cyber group out of Eastern Europe. Some have attributed it to Russia. We're still making sure to try to confirm that. We also know that so far the supply has not been impacted, supply of gas. But if it goes on too long, of course, that will change. We know right now that we haven't seen big price spikes or anything as a result of this. And we know that the company is doing everything it can to look under the hood of its systems to make sure that they have been able to contain and that the cyber attack did not inject any malicious malware into the system. They believe that they will probably have make a substantial restoration, I'll say, by the end of this week. So hopefully this will be a short-term disruption that won't really impact the lives of everyday citizens, hopefully. But I will say, David, that it speaks to the broader issue, that this issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away. This is a serious example of what we're seeing across the board in many places. And it tells you that we need to invest in our systems, our transmission grid for electricity. We need to invest in cyber defense in these energy systems. The private sector has to step up to the plate. Many are, but there's quite a few who have been slow to do so. And I think that these will serve as examples of why it's important to accelerate.
Well, that was the U.S. Energy Secretary Jennifer Granholm speaking to David Weston on Bloomberg's Balance of Power. Now, the biggest petroleum pipeline in the U.S. is still halted after a cyber attack forced it to shut down 3 days ago. Now, oil has fallen as traders monitor the fallout of the Colonial Pipeline closure and look ahead to OPEC's latest analysis of global supply and demand. Now, still with us to discuss commodities is Stephen King from HSBC. Stephen, I always get choked up speaking of supply demand. Are we in a super cycle, actually, because there's a danger that the economy is overheating, or at least a perception from traders is such?
Well, certainly the increase in commodity prices generally is a story associated with a very powerful recovery in some economies in certain parts of the world, most obviously the US, the UK, parts of Europe. And I guess that during the course of the last 12, 18 months, you probably also include China's initial bounce from the COVID infection. It's also important to remember, of course, there are many parts of the world that are still suffering hugely from COVID. Whether it's India or Brazil or other parts of the emerging world, there are still some tremendous difficulties out there. So the global economy as a whole cannot be firing on all cylinders. But having said that, the IMF is projecting that the US economy will be probably operating at a higher level by 2024 than would have been in the case in the absence of COVID. And that tells you quite a lot about the kind of demand for commodities now beginning to come through, which of course is why prices have been so much higher than they were. So in that sense, you could say that commodity price increases are a good thing. They're a sign of good things to come, as opposed to an indication of continued sort of post-pandemic weakness.
Stephen, in your note, basically talking about building back better, you argue that actually monetary policy is not doing the trick. What would do the trick to build back better?
So first of all, with monetary policy itself, it has increasingly worked through QE type investments and injections, which has lifted asset prices in general without necessarily allocating capital efficiently. In other words, the price signals in capital markets perhaps have not been working quite as well as they would normally do, because QE basically lifts all boats. And therefore, you end up, in one sense, keeping zombie companies alive or bigger than they perhaps should be, which makes it more difficult for new entrepreneurial companies to come in and shake things up and become more productive than would otherwise be the case. So when you think about long-term productivity stories, it's more about education, about geographical and social mobility, some of the kind of leveling up themes that we've seen in the UK and also in the US. These kinds of supply-side factors are probably more important than simply relying on a big fiscal or monetary stimulus. In other words, what's happening with our economies is not just a consequence of the pandemic. It is also a sense that over the last 15, 20 years, even predating the global financial crisis, the Western world bumped into a kind of growth and productivity constraint. Fixing that should be a major priority in the years ahead.
But what's the right way to fix that?
Well, as I said before, I think education is a big part of it, making sure that more people get access to good quality education, improving numeracy and literacy rates, which have fallen behind both in the US and in Europe over the last few years. Geographical mobility is another key factor. One of the big stories, again, on the transatlantic basis, is the fact if you're born into a poor community in a poor part of the country, your ability to move to somewhere else has been seriously curtailed, partly because of an absence of house building and consequently big changes in house prices between one region and another. These sorts of things are what has to change if you want to solve part of the productivity story.
Thank you so much, Stephen King, their senior economist, or senior economic advisor, rather, at HSBC. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China has seen its slowest population growth since the 1950s. It's sharply reducing the size of the labor force as the nation ages. Growth has been slowing for decades, and the population may well shrink in the coming years. That would mark a key milestone and have broad implications for economic growth and government finances. Some of the worst unrest Israel has seen for years escalated last night. Palestinian militants in the Gaza Strip fired dozens of rockets at Jerusalem and the south of the country. Israeli jets retaliated, killing 20 and injuring 65. Prime Minister Benjamin Netanyahu is accusing Gaza of crossing a red line. He thinks the current round of violence could last for some time. And Apple is facing a class action lawsuit here in the UK over claims it overcharged nearly 20 million customers in its App Store. It's another legal headache for the tech giant, already fighting other cases across the world. Unlike the case with Epic Games, this London suit is over alleged harm caused to customers rather than to developers. Apple says the case is meritless. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, up next, we speak to one of India's foremost COVID experts. That's as the South Asian country still fights a violent second wave of the virus. If you have any questions for us or for him, IB plus TV Go. This is Bloomberg.
There is some available information to suggest increased transmissibility of B.1.617. There is some reduced neutralization, and as such, we are classifying this as a variant of concern at the global level.
Well, that was the WHO's Dr. Maria van Kerkhove there speaking about the new coronavirus variant emerging in India. Now, she spoke as the country's second wave continues. India has recorded more than 300,000 daily infections for the past 20 days. Several states have entered local lockdowns, but the Prime Minister Narendra Modi is still refusing national measures. Meanwhile, the Seychelles is experiencing a spike in cases, despite 63% of the population being fully vaccinated. Now, with us is Lingadali Shashidhara. He's professor of biology of Ashoka University. Good morning, Professor, and thank you so much for joining us again on Bloomberg.
Good morning to you.
First of all, I don't know how much time you're actually spending looking at what's happening in Seychelles to give us a good indication, for example, on what kind of vaccine usage would work for India and other countries.
Well, I mean, all vaccines would work for Indian population too. At least the two vaccines we are using, it has been effective. We can see the downward trend in at least the disease and the mortality among the vaccinated cohort as against the non-vaccinated ones. But, as you know, all vaccines would prevent disease or reduce the severity of the disease, but not necessarily infections. So we need to be careful. We need to follow all the restrictions, even if we are vaccinated. But reduced vaccination is a major concern for India right now.
How is the vaccination process going in India? And how much of a danger is it that as cases rise and vaccinations are increasing, it will lead to, variants and mutations?
Exactly. As the number of cases increase, there will be more chances of new variants, and we need to somehow check this, through lockdown and variety of other measures. And unfortunately, the vaccination has taken a pause almost. It's a very, very slow motion in the terms of coverage, and we need to ramp up the production and the coverage. And hopefully, from the third week, from 20th May onwards, we are expecting that it will go into full speed, at least 1 million vaccination per day. That's the target from 20th May onwards.
Will it slowly get better, or does it, unfortunately, because of the way it's spread and the lagging time, that once you get infected, people can die 3-4 weeks afterwards? Does it have to get worse, or will it get worse before it gets better?
Well, I think, the lockdowns and variety of other measures, non-pharmaceutical interventions will make it better, but only transiently, right? As you all know, there wouldn't be there could be a third wave if you don't take other measures very tightly, particularly the vaccination. So we need to somehow be very careful in not letting our guard down now from now until all the people are vaccinated. Extremely careful. That's the only solution right now.
Are there enough lockdowns, Professor? Or how much more locked down does India need to be?
It's difficult. The lockdown, is not like a lockdown that we had last year, where everything was almost like a standstill. Right now, almost all non-essential things are stopped. Only the food delivery and such kind of or healthcare-related activities are on. And we need to continue like this for at least 2 weeks in every state, more or less, to keep the numbers very, very low. And we should not, sort of release ourselves completely unguarded until the vaccination is over. So we need to have certain level of lockdown continuously until vaccination is over. That's the only solution right now. It's incredible how many number of people are dying and how many more new mutations may come up from our population. We need to be very careful. The whole globe has to be very careful.
Professor, thank you so much. Lingadali Shashidhara, they're professor of biology at Ashoka University. Now, coming up, we'll have plenty more, of course, on the market sell-off as well, and we'll look at technology stocks. This is Bloomberg.
This issue of cyber attacks on our critical infrastructure, especially energy infrastructure, is not going away.
The industry understands that we are a target.
There's evidence that the actor's ransomware is in Russia.
This is Bloomberg Surveillance, early edition with Francine Lacqua, Matt Miller, and Keely Leinz.
Well, good morning, everyone, from London, Berlin, and New York on this Tuesday, May 11th. Our top stories today. Tough times for tech. That sell-off goes global. The benchmark index of Asian technology stocks has now plunged 30% from this year's high. Behind closed doors at one of the world's most exclusive banks, we'll tell you about the drama that's shaken this 2-century-old money manager for the very rich. And is no place safe while coronavirus cases are surging in the world's most vaccinated nation? Now, we do have quite a lot going on in terms of stories, and that, to put everything in perspective, is about inflation, and that global sell-off in technology stocks, Kaylee, really then snowballed in European and Asian trade.
Yeah, it's really all about inflation today, Francine. And to me, there are three parts of this story. There is the actual inflation data, there is the rally we've seen in commodities, further stoking inflation fears, and the impact all of it is having on big tech. So as you said, in the Asian session, we did see all of that evidence. Stocks were really lower across the board. We actually saw the Nikkei down 3% in Japan, and the Hang Seng Tech Index, which houses 30 of the biggest technology stocks listed in Hong Kong, fell as much as 4.5%, ended the day lower by 3%, but it's now down about 30% since its February peak. Of course, stoking the inflation fears in Asia specifically was the data we got out of China overnight. Producer prices up 6.8% year on year. That was more than expected, the fastest pace of growth since 2017. And rising commodity costs, input costs, of course, are part of that. And China is trying to crack down on the rally we've seen in metals like iron ore. The Dalian exchange putting some restrictions into place. So we saw futures under a little bit of pressure after the big rally yesterday. As far as what the picture looks like in Europe, as you said, it is big tech under pressure once again and really taking stocks lower across the board. It is red everywhere you look at Map Markets Go or WM Go on the terminal on the continent. The stock 600 at this point in time is lower by the better part of 2%. It is a broad-based decline today, but technology stocks are really among the biggest laggards, down 2.3% for that sector. On the subject of inflation, though, I would point not just to nominal yields in Europe, but break-evens. The 10-year German break-even is up about 2 basis points, 1.44%. That is the highest going back to 2014. As for what the picture looks like here in the U.S., of course, it was the NASDAQ 100 that led yesterday's losses, the index falling 2.6%, its worst day since March. Once again, futures lower by 1.2% on the NASDAQ this morning. In the bond market, the nominal yield on the 10-year up a basis point. We sit at 1.61%, but again, my eye is on break-evens. The 5-year break-even rate now above 2.73%. That is the highest going all the way back to 2006. Again, inflation expectations incredibly evident. On the subject of inflation and commodities, though, I would note we continue to monitor what's happening with the Colonial Pipeline, a key fuel conduit in the eastern United States. The company is trying to restart production, expects most of it, or transmission throughout that pipeline, to be back online by this weekend. So the disruption may be a bit more temporary than the market initially thought. As a result, oil under a little bit of pressure. WTI crude trading at $64.36 a barrel, Matt.
All right, Kaylee, we had some headlines come across from Germany as you were giving us your market roundup there, and it's the ZEW Investor Expectations Index. It's risen in the month of May to a level of 84.4. I've been working here at Bloomberg for 21 years. I started my job in Frankfurt. I have never seen this index climb above 80. So German investor expectations have climbed to what I believe is an all-time high as measured by the ZEW Investor Expectations Index. So with that out of the way, let's take a look at what's going on today around 6:30 a.m. New York time. The UK government lays out its agenda for a new session of Parliament in a speech by Her Majesty the Queen. Also, Bank of England Governor Andrew Bailey takes part in a discussion with New York Fed President John Williams at the alternative reference rates at 10:30 a.m. New York time. And then OPEC releases its monthly oil report later on. And of course, that is a commodity we've been watching incredibly closely over the last few days as this pipeline opens back up over the weekend. It'll be interesting to see those moves. But Francine, again, going back to German investor expectations as measured by the ZEW or the ZEW index, as you would say in jolly old England, it is pretty incredible to see it rise to an all-time high right now.
Yeah, and it just, it's from a low base, but there's so many questions also about what it means for actual real inflation. Now, on to commodities, and gas stations along the U.S. East Coast are beginning to run out of fuel as North America's biggest petroleum pipeline races to recover from the cyber attack that has kept it shut since late Friday. Colonial Pipeline says it's manually operating a segment of the pipeline and now expects to substantially restore all service by the weekend. Well, joining us now is our cybersecurity expert, Jamie Terabay. Jamie, President Biden says that Russia is not really responsible, but some of the software, some of the servers are in Russia. What's the nuance?
Well, thanks for having me. I guess in terms of Russia's possible role in the cyber attack, we haven't heard anything directly from the Kremlin and the Russians. That in the past they have denied involvement in cyber attacks, even though the U.S. intelligence agencies have concluded that Russians have been behind many attacks, including most recently the SolarWinds hack. What we know is that President Biden said there was evidence the hackers, all the software they used, are in Russia. And we know that private security companies who've worked with government agencies to, in this particular instance with Colonial, to stop data that was stolen during the hack, and they interdicted it from making its way to Russia, which is believed to have been the ultimate destination. In terms of Colonial right now, its CEO has said that the company won't restart shipments until the ransomware has been neutralized. That's really important because the cyber attack essentially hijacked Colonial's IT network. The company had to take all of its operations offline. And so there's a significant possibility that if the ransomware isn't completely removed, the hackers could have an opportunity to use their access to try to infiltrate the systems that control the pipes and flows. So that is a huge risk and a major reason why Colonial is operating some of the segments of the pipeline manually. As you just mentioned, there are already gas stations along the East Coast that are beginning to run out of fuel. We know there's been panic buying and long queues. The shortages have hit the aviation industry, and we've seen reports that flights have been forced to stop and add additional stops to their destination so they can fuel up. We also need to say that the pipeline serves 90 U.S. military installations and 26 oil refineries. So the ripple effect of this attack is still to be felt in so many ways. Colonial says it expects to substantially restore all service by the weekend. There is a massive race on to do so. It involves government agencies, the FBI, and a task force put together by the White House. That's not a certainty, though. It really depends on how easily they're able to remove the ransomware or resolve the ransom situation. So right now, it's still developing, and nothing really is certain.
All right, Jamie, thanks so much for joining us. Bloomberg cybersecurity reporter Jamie Tarabay on this developing story. Now let's go to China, where producer prices surged more than expected in April, fueled by rapid gains in commodities prices. It's adding to global inflation concerns, while Chinese officials have pledged to strengthen controls on the raw materials market to limit costs to companies. Joining us for more is Bloomberg's chief Asia economics correspondent, Enda Curran. So, Enda, what kind of inflation have we seen, and what kind of caps is the Chinese government going to put in place?
Well, we're starting to see pretty serious numbers on the producer inflation side of things now. Matt, like you mentioned, up 6.8% in April. That's the highest since October 2017. There is, of course, a base effect in all of this when you're comparing it to a year ago, but it's also reflecting two other things. Very strong domestic demand, and that's because China's manufacturers are going full pelt at the moment. And by extension, then, that's reflecting strong global demand. And we're seeing this big run-up in commodity prices across the spectrum. And all of that is flowing into China's factories. And then the question becomes, like you say, what can the Chinese government do about it, and what does it mean for the rest of the world? Premier Li Keqiang did say they're going to talk about or look at ways of trying to keep a lid on commodity prices to try and help those businesses that are suffering from it. We'll have to wait for details in terms of how the Chinese government plans to go about that. But then the next question becomes then, what kind of transmission will there be from these producer prices in China to the rest of the world? So far, the pass through from the finished manufacturing product to the high street is minimal, but it's going to be something to watch in the months ahead.
All right, Bloomberg's chief Asia economics correspondent, Enda Curran, thank you so much. Now, inflation fears also seem to be playing into the technology-led sell-off we've been seeing on Wall Street, as well as in Europe and Asia. Let's get more from Bloomberg's Danny Berger. Danny, it's painful out there.
It really is. And Kaylee, I have to say, it is so remarkable that we have these inflation fears for a second day come roaring back, when on Friday, the NFP miss was really seen as something that would let those fears ebb. But instead, we're talking now about the picture of perhaps wage inflation, the supply-demand mismatch across the market. So that means NASDAQ futures can continue to lead the losses in the U.S. pre-market session again. And in Europe, it really is a broad-based risk-off sort of day. Yes, tech is certainly leading declines, but we're still down nearly nearly 2%. Now, one of the more remarkable things about this is the bond market does seem relatively calm. Yes, we're up by about a basis point in the 10-year yield, but dollar is also flat today. So those aren't giving us the same signals. And let me take you into my terminal, because this is really one of the strongest rotations we've seen that hasn't been prompted by that higher U.S. 10-year yield. So these are the factors. Performance from yesterday in the U.S. session today looks very similar in Europe, where the best performing is going to be small cap and value. And on the downside, we have momentum and growth. That is a textbook reflationary sell-off. But it really, again, is being driven by this equity long short picture. It's not the macro managers that are participating in this. So maybe equity players now realizing they need to reassess the equity risk premium if we are getting inflation, something perhaps the bond market knows is coming further out, but is listening to the Fed in the near term. Kaylee.
All right, Bloomberg's Danny Berger, thank you so much. And it isn't just tech stocks that are under pressure in pre-market trading here in the U.S. Biopharma is as well, specifically a number of COVID-19 vaccine makers. Novavax sinking the better part of 12% in early hours after the company pushed back the timeline for its shot. It now doesn't expect to file for authorization for its vaccine in the U.S. or Europe until the third quarter. Moderna also lower by 4%, CureVac off by the better part of 3%, and even Pfizer is lower by 0.9%, even after its vaccine it makes with BioNTech was authorized by the FDA for use in 12 to 15-year-olds here in the U.S. yesterday, Francine.
Yeah, that's quite exciting news, and I know we'll talk a lot more about vaccines, and we'll look also at Seychelles and what exactly is happening there a little bit later on. Now, coming up, we'll speak with James Athey. He's Aberdeen Standard Investments Director. And then later on, Bill Dudley says markets are in for an interest rate surprise. We'll speak with the former New York Fed president at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
It's not transitory. We're going to continue to have what I call inflation, and that is devaluation of currencies. And I think, of course, with the way governments around the world have been printing and releasing new currencies into the market, particularly the U.S., you will have the inflation numbers going up, which basically is a reflection of the currency.
Well, that was the veteran emerging market investor Mark Mobius discussing the inflation threat earlier on Bloomberg. Now, joining us is James Athey. He's investment director at Aberdeen Standard Investments. James, given what technology is going through at the moment, it goes back to inflation, and a lot of these, let's say, richly priced stocks being sold off as people expect the Fed maybe to surprise the markets. Would you be a seller or a buyer of these stocks?
Yeah, it's complicated, isn't it, Francine? There's you go round and round in circles thinking about, growth outlook, inflation outlook, what that means for bond yields, and then you think about the Fed outlook and what that means for bond yields and the shape of the bond curve and what that means for the growth sectors versus cyclical sectors. And each and every one of these routes, you can see a pathway forward, but you can also see how it collapses in on itself. I look at the equity market and I think, where does fragility in the equity market come from? And partially it can come from obviously a weak growth outlook, but it can also come from the potential energy which is stored in that market. And when you have richly valued companies and incredibly bullish growth expectations across the piece, coupled with expectations of easy fiscal policy forever and a day and monetary policy which is going to sit idly by, it doesn't take much for there to be a disappointment on one or more of those factors. And I just think, realistically, markets were just that bit frothy considering where expectations were, and we're seeing some of that froth come out. I do think the market's bigger concern looking forward will continue to be the Fed and the extent to which they truly are going to sit idly by, and the extent to which this inflation truly is transitory.
They have to sit idly by for a while, don't they, James? If they want to keep any credibility, it would be ludicrous for them to change course at this point.
The implication being that they have a lot of credibility at the moment. I'm going to sidestep that one fear of talking myself into trouble. But yes, I think this is the game, Matt, right? This is the game that they are playing. This is what average inflation targeting must mean, because they say they want to communicate in advance, but they also only want to react from a policy perspective to realised outcomes. That's a total contradiction. They've got themselves in a complete paradox. But I think the game is you spoof the market in the short term by saying we're not going to do anything, we're not going to do anything, and then later, further down the line, when the recovery is more entrenched, it then becomes a bit more of a hawkish surprise. I've seen a few people talking in recent days about the idea that the Fed will have to play catch up and be much more aggressive in terms of hikes when we get there. So it's back to that sort of optimal control framework, but a bit more aggressive. You do nothing, you do nothing, you do nothing, and then you tighten aggressively. To my mind, that's just more volatility. You're just creating a bigger problem for yourself. You're creating bigger fragilities for financial markets. I don't think that's an optimal economic outcome at all, but I think that's where we're headed.
Speaking of another part of financial markets, James, obviously we have equities under pressure today, and yet in the bond market, there's not a lot of fireworks. Should I be looking at a 10-year yield that is higher than 1.61% right now?
Yeah, it's interesting, isn't it, Kelly? Obviously, everything's selling off today, which tends not to happen too frequently. Last time we saw that for any considerable period was 2018, when obviously the Fed was tightening and equity markets were concerned and perturbed by that. We may expect that, later this year or next year as well. The market again is conflicted with respect to growth, inflation, and what that means for bond prices and for bond yields. But realistically, I think the more proximate cause, shall we say, of the lack of upside fireworks for Treasury yields really is just, again, positioning and sentiment. We had a spike lower after payrolls. That didn't last very long. I can't imagine a huge amount of short positions were cleaned up in the aftermath. And since then, the technicals, if you like, suggest that because we weren't able to stick that rally, that's encouraged more bearish price action. And I think we've seen investors adding to their short. So I do think the short base is pretty big, and upside on Treasury yields is not going to be as easy to come by as it was earlier in this reflationary pricing.
James, thanks so much. James Athey, their investment director at Aberdeen Standard Investments. Now, coming up, Bloomberg Technology speaks to key policymakers, business leaders, and thinkers in Boston, exploring the state of biotech and education as the city begins to open back up. Emily Chang hosts tonight at 5:30 p.m. in New York, 10:30 p.m. in London, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get to the first word news. And President Biden says Russia has some responsibility to address that ransomware attack that crippled a giant fuel pipeline. The president stopped short of directly blaming the Kremlin, but he says there's evidence the hackers or the software they use are in Russia. Meanwhile, some gas stations on the East Coast say they're running out of gasoline. Colonial Pipeline says it expects to substantially restore service by the weekend. Last year, China posted its slowest population growth in decades. There were 1.4 billion people in the country. The annual average growth rate of 0.5% in the past decade was the lowest since 1953. That has sharply reduced the size of the labor force. Take it from sandwich sales. London's bankers, lawyers, and asset managers are taking their time to return to offices. That's demonstrated in sales from Pret-a-Manger. The restaurant chain typically sold about 200,000 lattes and 100,000 croissants a week before the pandemic hit. In an area that includes London's two major financial districts, Pret's business remains relatively slow. So, Francine, I guess my question is, when was the last time you went to a Pret-a-Manger?
So I feel like my household is like a microcosm of this, because I haven't been for a while, but my husband, who has been working from home, still gets it every day. But, so I think we're the only ones who have access to this data, and it's basically a good way of tracking if people stay at home and go to Pret or whether they come back to the office.
You don't stay at home and go to Pret, right? Pret is a place that you go to when you're at work and you're forced to, because there's literally no other choice. You have 5 minutes and you can't think of anything to eat but a BLT.
Yeah, but Matt and Kaylee, this is what I'm looking at the data, and it shows that the Pret index, and people say, well, what lawyer or what banker goes to Pret whilst working from home? And again, I have one at home, so I'm not sure what to say here.
Yeah.
They do actually have a ham and cheese croissant that they heat up so it gets kind of melty, and it's covered with a spicy ketchup. That's actually pretty good. I will say that.
Matt, you're just making me hungry. Hungry at 5:30 in the morning. Never good.
Always good to be hungry at any time of the day. What's interesting is also, you've seen it also with opticians, is actually businesses closer to home or closer to suburban areas. Certainly we've seen it in London and the outskirts. Business is just picking up because people are still not in the centre and the city of London. Coming up, we'll talk about maybe dynamics, north and south, the UK, London and suburbia with Simon French. He's Panmure Gordon chief economist. We'll look at the Pred Index. We'll also look at inflation forecasting. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Leinz in New York. Now, it's all really, Matt and Kaylee, about the markets, what the markets are doing, how they're repricing because of inflation, and that's really sent the correction on technology stocks snowballing into Asia and European trade.
Yeah, absolutely. Although, it's not too bad. I mean, we're talking about 2% and change drops. We've had a few of those over the last month, but I think, we're so toppy here, we're so frothy that we have the word sell-off on the tip of our tongue and we want to talk about this tumble. It isn't quite there yet. If you look at the longer term, we're still hovering near all-time highs. We're still looking at 5 times sales for the NASDAQ 100. So it's not, we're not in correction territory quite yet there.
Quite yet, but certainly it's rumbling on. Kaylee, what are you looking at the markets today?
Well, it's rumbling on, Francine. The older the session grows, the uglier the picture gets. Yes, as Matt said, we're still looking at losses with a 2% handle in Europe, but still the stock 600 technology sector specifically is down now by about 2.6%. And of course, it isn't the only sector in the red. The selling in Europe is really quite broad-based. Here in the U.S., the NASDAQ 100 did have its worst day since March yesterday, down 2.6%. And once again, this morning, futures pointing to a weaker open. We're down about 165 points, or 1.25% on NASDAQ 100 futures. In the bond market, things are relatively steady considering the picture we are seeing in the equity market. I would point, though, to the 5-year break even, how investors are gauging inflation over that time period. It is sitting at the highest since 2006, around 2.73%. Of course, the other story we continue to follow is what is happening with the Colonial Pipeline, and more importantly, its restart after that hack last week should be mostly operational by the weekend. So crude is a little bit lower today. We're down about 0.7% on WTI, sitting at $64.50 a barrel. Now, of course, with that big tech sell-off, one of the poster children of it yesterday was the ARK Innovation ETF, Cathie Wood's flagship fund. It tracks a lot of high-growth, high-momentum names, and all but 5 of the 58 holdings in that ETF were down yesterday. The ETF itself down more than 5%. And once again, in pre-market trading, it's lower by more than 3%. 2 holdings within that ETF, Square and Tesla, down about 3.25% and 3.7% respectively. And then, of course, we're seeing some pressure for other large mega cap tech names as well. Apple down 1.6% before the bell, Matt.
Before we get to the tech stock sell-off, I think it's important to share with our audience. Francine is going to get a dog, right? She wants to bring a puppy into the Lacqua household. And because of your obsession with break-evens, we thought of some great names. You were thinking maybe 5-year would be a good dog name. Fran thinks real rates, and I agree. Both of those, real rate or 5-year, a great way to call your dog. I want to just look at now one of the reasons. The kids don't know what that means, or your kids know what that means,
No, the kids don't know. The kids don't know about the puppy, so they're at school.
Oh, I didn't mean to spoil the surprise.
Sorry. They're not watching Bloomberg.
I hope they're in school right now.
Yeah, me too.
At least virtual school, right? I want to look at one of the reasons that I want to look at one of the reasons that we're seeing the tech sell-off, and it's been the inflation that we're talking about. But nowhere can you see that in a starker way than if you look at the Bloomberg Commodities Index. If you take a look at this chart I have, and for those of you listening on radio, I've brought it all the way back pre this millennium to the mid-90s, because I made a mistake earlier saying that the ZEW expectations were at an all-time high. Someone messaged in, no, they were higher in 1999. I was in college. I wasn't paying attention then. But this is indeed the Bloomberg Commodities Index at an all-time high, and it's taken off from the U.S. CPI. The BCom index at 5.5%, getting towards 6%. CPI year over year at 2.6%. So they've really split apart. Joining us now to talk about if we can expect inflation to go there and meet commodities is Simon French, chief economist at Panmure Gordon. And Simon, I will say that this means input costs are higher for manufacturers. A lot of manufacturers I've spoken to here in Germany say they're raising the end price on their products to consumers. Is that going to stick?
I think margins are going to be under pressure. Yes, we're seeing some considerable price inflation in the pipeline. You've got data, wholesale data out of Germany this morning, north of 7%. Producer price inflation out of China at 6%. The issue, really, the calculation for most people in the production industries at the moment is how sustainable will this inflation be? We've known for months, we've probably known for the best part of a year, it was going to come. We're going to get some strong base effects. How sustained they are and how suppliers trade off keeping their menu costs relatively fixed versus potentially calculating a higher input price environment. It's going to be a key calculation. For the time being, I think most corporates without considerable pricing power will look to absorb some of the most extreme price changes in their margins.
But Simon, where's inflation coming from? So, something that I heard could be that actually to counter the kind of infrastructure spending that we're getting in the US, we could see a lot of spending in China. So we could actually be importing inflation from China, and that would double up what we're already seeing with some of the programs put in place by the Biden administration.
Well, I think that's the right analysis in terms of the China producer price print that we got this morning. The last time we saw something at this level was the rebound in economic activity globally in 2016-17. That was also a 6-7% a year handle. But we saw a steady decline thereafter as growth momentum couldn't be maintained. It was more of a sugar rush. I think this is why inflation stories built on the story of stimulus checks are probably wide of the mark. It's unlikely to be a sustained inflationary environment. But to your point of where it's going to come longer term, if we can see a push up in the capacity utilization through big infrastructure spending in the US, pushing up demand globally with spillover effects, then we may see something more sustained. But I think Matt said he wasn't, taking notice in college in 1999, but that environment we had back in the 1990s, inflationary environment and previous to that, is not coming back.
Simon, what's productivity looking like across the world? So I hear both arguments, that productivity because of tech usage is better, but actually a lot of the central bank, QE or help is not helping with productivity.
So I don't want to sit on the fence on this one. I'm quite upbeat on productivity. I've written quite a lot about this. I think one of the Achilles heels to productivity over the last decade has been more acute in some European countries than potentially the US and Asia. But that Achilles heel of capital deepening, technology skills, you're having obsolete skills, companies not moving up the productivity frontier, they have been forced, in order to survive over the last 12 months, large portions of companies who hadn't ridden that technological journey have had to, out of necessity, in order to transact remotely. And I think the legacy of that period will be quite positive for productivity. So while there are concerns, counter-arguments around zombie companies, stranded assets, I think net-net, this period is actually going to be quite accretive for global productivity, and it is the silver lining to the pandemic.
Simon, I want to focus on the labor market. Here in the U.S., we're going to get JOLTS data at 10 a.m. Eastern time, a leading indicator for what hiring and employment looks like. How concerning is the labor shortage specifically? Are we going to start seeing some wage pressures here?
So one of the things that I don't think was fully unpacked following the non-farm payrolls miss on Friday, and we'll get it again with the jobs data today, is there's frictional shortages of labour matching at the moment. At the moment, there's a big shock in labour supply. A lot of US workers left the labour market. Patterns of demand have changed. And only on a spreadsheet does job demand and job supply match up neatly. In the real world, frictions exist. Frictions of geography, frictions of skills. So I don't worry too much on the job demand side, but we do need to see evidence as we go through the summer. We're not making an instant reaction today. We need evidence through the summer. The supply side is relatively flexible, and we can see participation rates moving back up to 63, 64% to reassure those policymakers, both in the Treasury and in the Federal Reserve, that the US labour market is in rude health once it's through those frictions of the summer.
Simon, thank you so much. Simon French, their chief economist at Panmure Gordon. Now, a COVID surge in the world's most vaccinated nation has raised concerns that inoculation is not helping turn the tide in some places. Seychelles saw active cases more than double in the week to May the 7th. Now, joining us for more on this is Sam Fazeli, our Bloomberg Intelligence senior pharmaceuticals analyst and director of research for EMEA. Sam, thank you so much for coming on. What exactly is happening in Seychelles? So we understand that a critical amount of people were vaccinated. 57% of those people were with the Chinese vaccine. First of all, are all vaccines created equal?
Hi, Francine. Well, we know the answer to that, and that is not the case. Not all vaccines are the same. We've seen data ranging from 60% or so prevention of symptomatic COVID right up to the 90-95% that we've seen with the Pfizer-BioNTech Moderna vaccines. So the answer to that is an easy, simple no.
But is the answer to the question of what is happening in the Seychelles, for example, an easy answer in that you can just point directly to a vaccine, or could variants be at play here? Or that we don't have enough data to actually have a clue as what's going on. The things that they need to work out is what's the percentage of people who are testing positive with a vaccine dose, which vaccine, how long after their second dose of vaccine, and also what's going on with regards to hospitalizations and deaths. A lot more is needed to know here, for us to know. I can tell you, for instance, in Chile, the similar vaccine that's being used, which is Sinovac compared to Sinopharm, which is being used in Seychelles, is only just shy of 70% effective in preventing symptomatic COVID, but closer to 90% effective in preventing hospitalizations. So we need to know these bits of detail before we make any conclusions.
Right. What we do know, though, or at least the facts with which we've been provided, are that 37% of those who've been infected have had both doses of their respective vaccine. So either the Sinopharm vaccine or the Astra clone that's made out of India. And that compares much worse with the other countries that you're looking at, right, Sam? Or do you see other countries where a high number of people who have had both doses of any vaccine are getting infected?
No, I'm not seeing that at all, Matt. And as I said, we have to know what percentage of that 37% was vaccinated in terms of 2 full doses 10 to 14 days after the second dose relative to the date of infection. Because if all these people had been infected 2 weeks or a week or a day after their second dose, they didn't have full protection. I'm not going to try and paint a perfect picture saying this is not variants or anything like that. But I think we need to know a lot more before we can jump onto the variant bandwagon.
Sam, thanks so much. Our Sam Fazeli there with the very latest on the Seychelles and vaccines. Now, coming up inside the world of Swiss banking, we'll take you through the tensions at Banque Pictet. That's coming up next, and this is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, IBM Chairman and CEO Arvind Krishna joins Caroline Hyde. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, and Leinz in New York. Now to a Bloomberg exclusive, and it's about the secretive world of Swiss banking, which is finding some tensions adapting to the modern world. Now, Pictet, which oversees more than 600 billion francs in assets under management, has seen a clash between new hires and old hands, and in recent years, the departure of key employees. Our Swiss Banks reporter, Marion Halftermeyer, has been following the story, and she joins us from Zurich. Marion, you wrote this big take, and it took you at least 6-7 months to actually try to get to the bottom. You've spoken to people that were directly involved in the story. I mean, Pictet, just to put it in context, is one of the most secretive but also old Swiss institutions.
Yes, exactly. It is a distinctly not very well known, but very big and secretive. It's sort of one of the last standing banks of the old era of banking secrecy and secretive Swiss banking in sort of the more fairy tale-esque way of looking at it, I guess you could say.
So, Marion, there were these 7 partners at the top with a senior partner, and basically tensions arose. This was a family enterprise, but actually, I guess more and more it gets diluted as a couple of people got brought in from the outside.
Yeah, exactly. So this is a bank run by 7 partners, many of whom are descendants of the founders of the bank. So we're going back to the 1800s at this point, and it's exclusively been run by these 7 men. Over the years, they've brought in some new talent. More recently, Boris Clardy, who was the former CEO of Julius Baer, and they've been trying to see how they can modernize a little bit. There's been a bit of profit margin pressure across the industry. They're not outside of that, so that's sort of a little bit the impetus for this. They do see, the wealth growth in Asia as a key area to capture next. They've been a bit slower than the other banks because they're not publicly listed and they don't have that investor pressure, and they do still have very high profitability compared to the other banks. Some of the other banks could only dream of sort of 20% return on equity.
In terms of secrecy, though, Marion, the Swiss regulation is making that really difficult from an account perspective, right? I mean, we are no longer in the days where you can have a numbered Swiss account and they're not going to divulge any of the information to the IRS.
Right, Matt. So the notion of sort of historic Swiss banking secrecy has been mostly dismantled. When we say secretive and when we say Pictet's sort of still like that, we're more referring to the old style of banking and where there's actually secrecy within the bank. So prior to maybe 5 or 6 years ago, individual bankers weren't really disclosing to their employer who they were banking. In a very detailed way. They weren't sort of required to share that around. They were kind of running the business independently. And now that's sort of changed as the business has come under pressure and the bank wants to see, okay, which clients are more profitable than others. And it's become much more metric and targets oriented. You get things like net new money being thrown around, which are terms that weren't being thrown around before.
Marion, let's focus on the bankers themselves, because the line that stood out to me in this story was in its entire history, only 43 people, all men and all white, have made it to managing partner. When we talk about modernizing Pictet, is that also going to mean diversifying leadership?
That is a very good question. I mean, they will need to answer that question. It doesn't sit just there. I mean, you have the 7 white men at the top, but below that they have a crop of senior managers that they label equity partners who have a mini stake in the bank as well. And out of those, there's about 40 of them, and there's only 2 women, and it's looking very white there too. So it's something within the entire bank that they're going to have to grapple with, and I think especially if they're moving outside of Europe, they're going to have to look at their talent and answering that question, right?
Marion, thank you so much. And of course, for everyone who's not read it, it's a fantastic read. You can find it on the website or on the terminal, written by Marion Halftermeyer. Now, later this morning, Bill Dudley says markets are in for an interest rate surprise. We'll speak with the former New York Fed president about his latest opinion piece. That's at 7:30 a.m. in New York, 12:30 p.m. in London. And this is Bloomberg.
while you don't want to be preemptive, you also don't want to be so reactive that you're late. In that we have the tools to deal with these inflationary issues, but when you use them late, they can have a jarring effect. So I think that the challenge for us is to find the balance.
Dallas Fed President Robert Kaplan speaking with Bloomberg's David Western yesterday. Now, Tom Keene, co-anchor of Bloomberg Surveillance, joins us now. Tom, I love having you on to talk about your program, but also what you're focused on, because it's always a little bit of a surprise. So is it tech or is it the Queen today?
Well, you know, it's a bunch of things. I think the Queen today is symbolic, and certainly with the death of Prince Philip, it will be emotional within, I believe it's 74 people watching on in COVID London. But there's much more going on, and certainly it's a tech sell-off, Francine. Much of it personified by Athey over at ARK. Let's go to the chart right now, because I think, Francine, it really brings up the reality of the explosion in technology. And back 4 years, log ARK is back to only the trend. It's a reversion to the mean. And so that shows how extended technology was over, say, the last 7-8 months.
Yeah, and actually, if you look, I guess, at the generalized inflation concern, it's also impacting some of the government bond yields, including the U.S. 10-year, but also the German Bund, Tom.
Yeah, the yields are moving as well. I would really note, I mentioned this to John Farrow in our preparation, our vast hours of preparation that we go through every morning, that the 2-year yield has really come back to pre-jobs day of 0.15. So is President Kaplan mentioned of Dallas there, you're getting back yields to where they were pre the job shock, and we'll see where we go from here.
Tom, I'm looking forward to the program. I think you're also speaking to Bill Dudley a little bit later.
We have Bill Dudley later, yes. Yes, it'll be timely.
The interview of the day. Tom Keene, co-anchor of Bloomberg Surveillance. A pleasure, as always. Now, we're also, of course, watching the Queen's speech. It's in half an hour from now. And for those of you less familiar with the monarch of the United Kingdom, this is not actually her speech. It's written by government, and it kind of actually lays out, you know, what the government wants to be then pushed through parliamentary session. So we understand that it could have around 25 bills or 25 proposed pieces of legislation.
I wonder, you know, I'm not 100% sure about the power that the Queen has. I think she has an ultimate veto, although she would rarely use it, and she didn't after Brexit, for example. I wonder, does she have control of the military as well? Because if I were her, I think I would just take back the UK. It seems to be breaking apart. It seems fairly directionless. And it's time maybe for, after all, she was put in charge by divine intervention for the royal family to retake their country.
And that is why, ladies and gentlemen, Matt Miller is not Queen of the UK. We'll focus, of course, or she'll focus through the government on adult social care. Matt Miller, voter ID at polling stations, but also asylums. So we'll have plenty more on that. And again, it's the Queen delivering it, but actually it is what the government wants from Parliament for the next 12 months. Coming up in the next hour, John Vale, Nikko Asset Management Chief Global Strategist.